If you want to invest with clarity, not noise, you need one thing: a valuation you can defend. This is the MarketSnap Intrinsic Value Calculator. It's built to answer a simple but powerful question: at what price is this stock worth buying? In this video, we'll run a full valuation live on a stock using real financial data, analyst estimates, and our own assumptions, and I'll walk you through each step of the process. So yeah, let's run it live. No theory, no spreadsheets, just structured due diligence. Best way to learn this is hands-on. Open marketsnap.com/intrinsic value, and while you watch, follow along with me and pause whenever you want to test an assumption or play with the inputs. Now, before we dive into the numbers, here's the mental model. Think of this app as 5 stacked layers: historical financial data, projection estimates you control, the discounted cash flow engine, a multi-model valuation dashboard, a live sidebar that updates your margin of safety. We're going top to bottom. And the nice part is, you can run your first valuation without logging in. Creating a free account unlocks deeper historical data, up to 10 years, which is very useful to project estimates using historical averages, especially for well-established companies. All right, let's start with the technicalities. Let's pick NVIDIA as an example. I'm entering NVDA. Quick note before we continue: this video is not financial advice. It's for educational purposes only. The valuation we're building here is simply an example to show you how the tool works and how to structure your thinking. We're demonstrating a valuation framework, not recommending any specific stock. This is not a buy or sell recommendation. The numbers reflect assumptions, and assumptions can change from person to person and from day to day. The goal is to help you understand one of the ways to value stocks and encourage you to run your own assumptions and build your own valuations before buying any stock. Let's start. You'll see a series of financial metric tables. Some are essential for the calculation. Some are less critical, but still valuable depending on how deep you want to go. The built-in guide already labels each section by priority. That alone can save you a lot of time. And by the way, the guide can be useful for the first few times, then you can collapse it. Here's how I personally use it. If I'm looking at a company I've never analyzed before, I'll often run a critical-only valuation first: revenue, net income, free cash flow, default parameters, just enough to see if it even deserves attention and time for an in-depth analysis. If the output already lands in the too hard to consider bucket, I move on. If it looks promising, I come back and run it properly, going through every metric in detail. That's discipline. Now back to the tables. Gray columns are historical. Highlighted columns are projections. And each table allows 4 estimate modes: analyst estimates, growth rate, percent of revenue for margin-based metrics, custom, manual year-by-year values. If you use growth rate, the app compounds forward from the last historical year. Okay, let's start. The first table is revenue, obviously a critical one. I will use analyst estimates for simplicity, which are available when you subscribe to MarketSnap Full Access for less than $10 a month. Use them like a starting point, not a religion. Analyst estimates can sometimes be biased. Before accepting analyst estimates, compare them to historical CA gear. If the company grew 6% historically and analysts assume 15%, that's a big deviation, and you should know why. This is where the stock details side panel becomes handy, where you can find additional information and news, but I will explain this later. For now, just remember, analysts can be biased, so use their estimates as a starting point, not a religion. All right, next one. EBITDA is shown mainly for operating context. It's not critical because we'll focus on net income. It strips out capital structure and certain accounting effects, so you can quickly see how the core operations are performing. It's not used directly in the discounted cash flow here, and it shouldn't replace net income or free cash flow, but it helps you spot structural operating strength or weakness before financing effects. If EBITDA margins are unstable, it's worth asking why before projecting smooth long-term growth. Next, net income. Now we get into the important stuff, a critical one. Are net margins expanding or compressing over time? Revenue growth alone isn't enough. If margins are deteriorating, bottom-line profitability won't scale the way you expect. This is where percent of revenue mode becomes useful. You can set a realistic long-term margin assumption and let the app project net income automatically based on your revenue forecasts. Margins are where optimism often hides, so be conservative. And quick note here, if you're newer to financial statements, the charts can help a lot. Visually seeing revenue, net income, and free cash flow often reveals patterns faster than reading numbers in a table. You can immediately spot unusual spikes, margin compression, or cash flow instability, even if you're not deeply technical yet. This will help you tremendously with projections, saving you from typos, analyst mistakes, or simple currency conversion errors. And by the way, when you deal with non-US companies, keep an eye on currencies. Sometimes financial statements can be messy, and analyst data may not be in the same currency as the reporting one. All right, moving on. SG&A is another non-critical one. It doesn't impact the calculation, as it's already reflected in net income, but it's shown to evaluate operating cost discipline and margin sustainability. If SG&A as a percentage of revenue keeps rising, future margin expansion assumptions should be conservative. Now we move to free cash flow, and this is where the valuation becomes real. If net income was a big deal, this is the big deal. This is the actual engine of the discounted cash flow, the most critical metric. Projected free cash flow feeds directly into the valuation model. Before projecting anything, check. Is free cash flow consistently positive in historical years? Is it volatile? Is this a cyclical business? How strong is free cash flow conversion relative to net income? If free cash flow is weak compared to reported earnings, that may indicate heavy capital expenditures or accounting distortions. Revenue can grow, earnings can grow. But if cash doesn't follow, valuation assumptions need adjustment. This is the trickiest part for a few reasons. Because there aren't always analyst estimates for free cash flow. Because free cash flow isn't as linear as revenue growth. Because, and this is the real challenge, forecasting free cash flow requires multiple assumptions. That's where external information helps. This is why we've integrated the Stock Details side panel, so you can view the company details page and pull additional information directly from the app without switching tabs. For example, you can see the latest earnings call summary or the latest SWOT analysis. This is a goldmine of information when projecting future estimates. You can also use the built-in AI assistant for guidance, but I strongly recommend understanding how this works first. AI should validate your thinking, not replace it. This is due diligence, not guesswork. Now at this point, all the critical metrics are set with their projections, and for quick stocks pre-filtering valuations, you could eventually stop here, and the discounted cash flow would already provide a valid result. We'll keep going with a deep dive analysis instead, so I'll go through all the metrics. But if you ever stop here in the future, remember a few things. First of all, discounted cash flow valuation alone is not a religion. Second, it doesn't work for all companies. I will talk about this in a moment. This is extremely important, so make sure you follow up this later on. Third, even when it works well, there are other market dynamics and valuation methods that can drive prices far away from this model. Okay, now let's keep rolling with the deep dive analysis, and let's briefly go through the other sections in the calculator before we move to the valuation parameters. Net debt position. This one matters more than people think. Net debt is important. Net debt equals total debt minus cash. Discounted cash flow gives you enterprise value, but debt changes the risk profile. If net debt is rising aggressively, your discount rate should probably reflect higher risk. Debt-heavy companies may produce attractive discounted cash flow outputs, but capital structure matters. Shares outstanding, dilution check. Now this is one of the most overlooked metrics, and one of my favorites actually. Intrinsic value per share is calculated by dividing enterprise value by shares outstanding. If share count is increasing year after year, future per share value may be diluted. Even if enterprise value grows, per share returns may not. On the other hand, if a company is buying back shares, that gives you a larger slice of the pie. Think of the company as a cake. If the value stays the same but the slices increase, each slice becomes smaller. Always check the trend. Then next, EPS, earnings per share. Even though it's not in the discounted cash flow engine, it still matters. EPS doesn't feed the discounted cash flow directly, but it drives the forward PE valuation model in the dashboard. Many investors price stocks primarily on forward earnings. That means EPS alone can move a stock, even if free cash flow lags. Projecting EPS realistically allows you to compare intrinsic value versus earnings-based valuation, see whether the stock is expensive on a multiple basis, understand what the market is paying for each dollar of earnings. This is why we show forward PE alongside discounted cash flow. Last relevant metric is PE ratio, under valuation metrics section. Here you can find historical and forward PE. This table shows what the market historically paid for this business. If the stock usually trades at 18x earnings and now sits at 35x, your discounted cash flow assumption must justify that premium. Historical valuation ranges are powerful context. Next, you'll notice there's a valuation tips section. Now, this section exists because not every business should be valued the same way. For banks and insurers, the price to book and ROE matter more. For unprofitable growth companies, revenue growth and path to profitability matter more. For established profitable companies, discounted cash flow plus multiples work well. The calculator adapts guidance based on industry because valuation is contextual. Now that we've reviewed the broader financial context, we move to the actual valuation parameters, because assumptions without context are just guesses. All right, now we're at the knobs that actually move the valuation. The valuation parameters have three core inputs: required return, discount rate. This reflects the return you demand for the risk. Blue chip, maybe 9 to 10%. Riskier growth, 12 to 15%. Perpetual growth rate, long-term growth beyond your projection window, usually 2 to 3%. It must be below the discount rate, or the math breaks. Projection years, how many years of explicit forecasts? Usually 5 for stable companies. The app calculates intrinsic value per share using discounted projected FCF, terminal value, Gordon growth model, divided by shares outstanding, MarketSnap model, all in real time. Now we're going to talk about how to read the output without fooling yourself. Let's read it properly, because this is another place where people go wrong. The numbers you'll see are discounted cash flow valuation, MarketSnap value, and current price, followed by their corresponding margin of safety, updated live in the sidebar. Discounted cash flow valuation. This is your pure traditional discounted cash flow intrinsic value. It's based entirely on projected free cash flows, discounted back to today. This answers the question, what are the company's cash flows worth if my assumptions are correct? MarketSnap value. This is not random, it's a structured composite. It blends your discounted cash flow foundation, forward PE analysis, share structure dynamics, quality metrics, industry and market positioning. So instead of choosing between cash flow intrinsic value and what the market pays, MarketSnap forces you to see both. Discounted cash flow might show minus 8% margin. MarketSnap value might show plus 102%. That divergence is not a bug. It's telling you something. It means your cash flow model and market-based intelligence are seeing the business differently. That's the point. How to think about it. If discounted cash flow and MarketSnap value cluster near each other, you likely have a clean and stable valuation case. If they diverge widely, this means that either the business is structurally complex, or market sentiment is extreme, or your projections need revisiting. This structure exists so you don't anchor to one number. It forces layered thinking, cash flows, earnings multiples, quality, share structure, market positioning, and that's exactly how valuation should be done. This is your base case, built on your own assumptions. From here, you can activate scenario mode and model alternative outcomes. Scenario mode lets you model a bear case and a bull case by adjusting the underlying valuation outcome so you can visualize how sensitive your thesis is to optimism or caution. Now, you may have noticed that I skipped the key metrics section above the results. I did that intentionally, just to avoid overwhelming you with details at this stage. It's important, but it's not the primary valuation output. The key metrics section is essentially a structured summary of what matters. It's fairly self-explanatory, and it highlights forward PE analysis, share structure, financial quality, industry position, market comparisons. But don't treat any single number as a buy or sell signal. That's why this structure exists. It forces you to cross-check instead of falling in love with one number. Now, once you've built a valuation you're happy with, don't let it vanish into a one-off session. You can save it and come back later, especially after earnings, guidance changes, or big price moves. So you're always reviewing the same framework, not starting from scratch. And if you want a second set of eyes, you can share it to MarketSnap Nexus and get feedback from other investors on your assumptions. Or if you prefer, export the key takeaways and share them wherever you already discuss stocks. Your group chat, Discord, Reddit, X, whatever your platform is. Because the goal isn't just to get a number, it's to make your reasoning visible, testable, and improve it over time. Now let's talk about common mistakes that investors make when trying to value a company and how MarketSnap helps you avoid them. A few mistakes show up constantly. Terminal growth too high. If you push terminal growth above 4%, you're implying the company outgrows the economy forever. The model may still produce a number, but it's not a serious assumption. Bring it back to a conservative range. Discount rate less than or equal to terminal growth. If terminal growth meets or exceeds the discount rate, the terminal value math breaks. The app enforces this, because otherwise you get nonsense. Blindly accepting analyst estimates. Analyst projections are useful, but they need context. Compare them to historical CAGR and to management guidance. When estimates imply a structural step change, you need a reason, not faith. Using discounted cash flow where discounted cash flow doesn't belong. Financial companies like banks and insurers don't fit classic discounted cash flow logic. And companies that aren't sustainably cash flow positive can also produce misleading discounted cash flow outputs. In those cases, you lean more on multiples, revenue trajectory, and quality signals, which is exactly why the dashboard exists. Ignoring dilution. Check shares outstanding. If the share count keeps expanding, per share intrinsic value is quietly being diluted. Before we conclude, let me remind you again. If you want to go deeper while you build the model, open the Stock Details side panel. This is deliberately integrated so you can pull context without switching tabs. Things like earnings call summaries, SWOT analysis, qualitative notes, and company context. Those pieces matter most when free cash flow is irregular, because that's when projections need real-world reasoning, not just a growth percentage. And again, you can use the built-in AI assistant as a guide, but the right way to use AI is to validate your logic, not outsource it. The framework comes first. To recap, the workflow is load the company, choose projection modes, analyst, growth rate, /cent of revenue, /custom. Build assumptions you can defend, run discounted cash flow, cross-check with the dashboard and MarketSnap value, and then decide whether price is offering you a real margin of safety. And if you want a second set of eyes on your assumptions, that's what the MarketSnap Nexus community is for, discussing the reasoning, not the headlines. Stop reacting to price. Start interrogating value. Run your first valuation with no login. And if you want analyst estimates inside the workflow, that's included with MarketSnap Full Access. Link in the description. This is educational, not financial advice. Always do your own research. Have a great day.